This market seriously reminds me of my girlfriend and her swimming skills. Hear me out here. So she can't swim. It'll be like 5 foot of water. She's like 5 foot ½ inch. She holds on to the ½ inch. She's like 5 foot. So she's like drowning in 5 foot water. It was honestly the funniest thing. But her face up top, when it's out of the surface, she's trying to, not panic, right? She's trying to play it cool, like she can swim. Under the surface, she's going crazy, right? That's what the markets are doing over the last 2 days. The markets are looking and pricing at a recession. They're disagreeing with the Fed. They're saying, no, Fed, you're not going to be able to raise as aggressive because we're going into a recession. But on the surface, the markets are not really falling in the way that the data shows it should be. We're going to talk about it. The US dollar is strengthening yet again today, and this is really the one thing you guys need to watch is the dollar. What the hell is happening? So we have a lot to talk about. We're going to talk about AMC. We're going to talk about how this affects growth stocks, because growth stocks did very well yesterday, but they're not doing as well today. So the work is cut out for us here in this video. Hit that like button and subscribe to the channel. Comment down below. What is your take on all of this? What do you think is about to happen? What do you think about the end of July, beginning of August crash scenario that I have been playing out? Or if you don't know about that scenario, let me know that as well down below in the comment section. But let's get into this video. If you guys want to come trade with me live in real time, a link down below in the description, as well as the link in the description for Webull, Moomoo, and Public. Check that out. Get yourself some free money. So first things first, why I use that analogy of my girlfriend trying to swim in a 5-foot pool and she's essentially drowning, but she's trying to stay cool above the surface, because that's what the markets are doing. The markets had a very green day yesterday. The S&P was kind of flat yesterday. A lot of growth stocks really outperformed. The NASDAQ was up over 1%. The SPY was pretty flat, but it was still in positive territory, and now it's only down 0.39%. We did get some economic data, which we'll talk about, which is not a good thing. It wasn't good economic data. And then we get the FOMC minutes coming at 2 p.m. So that's going to play a role, as far as what happens. And we're going to talk about the last FOMC minutes and what happened there. But the data here is really alarming. So if we look at the dollar, right, and we go ahead and pull up, we could even pull up the S&P and underlay this to try to compare them. But typically when the dollar is breaking out to a new high for 2022, the markets are falling, right? When UUP, look at this whole thing. UUP actually went down a little bit, markets went up a little bit, right? We started to climb with UUP and the markets were selling off, selling down. We fall and the markets come back up, right? We rise again, markets continue to fall. Well, now the markets really were rising this whole time as UUP was falling, and now UUP is rising and the markets are not falling as aggressive, right? So there's this discorrelation that's kind of going on. We're hitting new highs for the dollar, but the markets are not hitting new lows like we have seen throughout 2021 or 2022 so far. So that's the biggest thing you guys need to be watching for, is how high does the dollar go? If we look back to what happened during COVID and we take the S&P off of here, you can see what happened with the COVID crash. People freaked out, and this is showing you fear. People start to flood to the US dollar, and then, obviously that crash didn't last too long, so UUP did come back down. But this one, we're just breaking out to new highs, and, the markets are not reacting. So the markets are probably going to fall in a pretty big way, as UUP continues to climb and make its way to the upside. So this is probably the biggest chart to pay attention to. It does have a lot of implications for specific countries and foreign exchange currency, foreign exchange. American companies doing business overseas, it's less desirable when you have a strong currency. So there's a lot of implications like that. Feel free to add, some more clarity for people that don't understand the relationship with foreign exchange and what's happening with the US dollar. Add it down below in the comment section if you guys do want to. But the higher this goes, the worse the situation pretty much is. So you have that. We do have some economic data that came out today. The job openings fell in May, but still outnumber available workers by almost 2 to 1. Job openings totaled 11.25 million for May, a considerable drop from the upwardly revised 11.68 million in April, according to the Labor Department's JOLTS report. There were 5.95 million people counted as unemployed in the month, meaning that there were 1.9 openings per every available worker, still around historical highs. The ISM Services Index for June fell slightly to 55.3, but that was better than the estimate. So ISM Manufacturing PMI, that was good, right? But you still have 1.9 job openings per unemployed person. So that's where you run into a problem. That's where the Fed can say, hey, look at the job market. It's so strong. How are we going into recession? Well, we're not going into recession. These are the things that the Fed is saying, that they don't expect a recession, that the economy is in a good place to be able to withstand rate hikes. And the job market, that's exactly what it's telling the Fed. But the stock market over here and other real economic data like personal spending, personal savings rates, so on and so forth, are showing that people cannot withstand higher interest rates. That is going to be a big no-no for the Fed, right? And the best way to understand this really, easiest way to boil it down, if you look at the bond market, you look at the US 10-year Treasury right here on CNBC, when the Fed is raising rates 75 basis points, the last meeting, we're expecting that again at the next meeting, right? And likely after that, 50 basis points at least, or if not 75 basis points. Well, the US 10-year Treasury should not be dropping off of that. If the Fed is raising rates this aggressively, it should be continuing to rise and going up, right? That is the financial tightening that the Fed has said the markets are accurately pricing in. The Fed said at their last meeting, and he says this in front of Congress, the last couple of speeches he's had, that the markets are fairly pricing in what Fed policy is doing, that there's not a big disconnect there. Well, over the last couple of weeks, you have seen the bond yields coming down in a very big way. And that should not be happening. That is because people are more fearful about a recession. And, the more the markets give the Fed as far as leeway to raise rates to fight inflation, and the longer the bond yields stay down, that is a big, big red flag. And something is about to break in the markets. It's likely, as the markets realize the Fed will raise rates, as we are seeing 2 negative quarters of declining GDP growth by the end of July. That's probably when you do get this event where the markets do snap and you could see a pretty big move to the downside. So there is that. We do have the FOMC minutes later in the day today, like I said, around 2 p.m. And that's going to be important because the last FOMC minutes, we actually seen like a 3% positive day to close out the day. And then it was negative like 4% the next day, right? That digestion of the FOMC minutes was not a very bullish thing, but you did have a bullish reaction after the FOMC minutes. So that's kind of what I expect for today. It wouldn't surprise me to see this flip-flop and we have a really bad close to today and then tomorrow potentially rips. You're probably going to get that 1 and 1. So if we rally today, we'll probably fall tomorrow. If we fall today, we'll probably rally tomorrow. It's not a science here, but that has been the overall trend when it comes to the FOMC minutes or even the rate hike decision itself. We tend to rally once the news comes out, once the data comes out, and then we tend to fall the next day. So it wouldn't surprise me to do something along those lines. And that's pretty much it throughout the rest of today. The FOMC minutes at 2 p.m. Tomorrow, ADP employment change for June and the balance of trade for May. Those are going to be the two big things for tomorrow. The balance of trade specifically, I want to pay attention to because it's going to be the trade deficit. So we run at about an 87.1 billion trade deficit for the month of May. That's what we're expecting. If it comes in much higher, then that's obviously going to be very bad because markets will say, hey, this is probably a leading indication of a recession that is coming. So very important recession data coming tomorrow as well. So it's going to be a big week, really, because on Friday you have non-farm payrolls and the unemployment rate, as well as some more Fed speakers. Those Fed speakers will also be important because if they change the tone of policy, if they start to agree with the markets and say, yeah, maybe we shouldn't be raising rates as aggressively, well, that's going to be a big event. That's going to be a big change of policy. It's going to move the markets in a pretty big way. Now, the yield curve as of right now, it just looks unchanged. We're still inverted to a pretty good degree. So that is one of the most highly looked at and respected ways of, predicting a recession, pretty much. Over the next 6 to 12 months, typically when the yield curve inverts, you will see a recession. That even happened before the COVID crash in September of 2019. Some people think it's a fluke. Some people, thought maybe the bond market knew this was coming. Who knows? But we are inverted, and that is a sign of a recession. So there you have that. Something else I find very strange is the Russell 2000 is down 1.5%, whereas the NASDAQ is only down 0.39%. So you're definitely seeing a lot of shorting with the Russell 2000 and on the index itself, but also individual companies such as AMC. We know AMC is a part of the Russell, the largest component, and it's down about 4.11% today, as you are seeing a lot of that shorting. We did struggle to break out and found resistance around the 50-day moving average earlier in the day today. You guys can see that as the top tick of this wick here on this candlestick for today. So that's not really a good sign. Worst case scenario, you probably fall back down to 1150. Better case scenario, we can get a rally off the FOMC minutes that could continue, and we could start to break out above some of these moving averages we have right here. So there is that a little bit on the technical front. That's kind of why AMC is falling today. It's nothing company specific. It's just the Russell in general is getting beaten to a pulp today. Now the RSI is at 45.38 under that neutral level of 50. The MACD is still very, very bullish. So there you have that. A little bit of a mixed bag. Still in an overall uptrend. You're still up from the lows quite considerably, but we're definitely going to want to see if we can continue on this uptrend. We could very easily break into a downtrend here. Last thing that I want to see. We're still, like I said, off our lows a lot at $9.70 per share, still sitting at $12.28 per share. But I do think as this recession continues to build, and as we do get closer to being confirmed in a recession by July 28th, and we get that negative Q2 GDP print, then actually some growth stocks will start to do better, like we seen yesterday, because investors are willing to pay for growth when there's no organic growth in the economy, right? Growth investors, they like to buy growth stocks, right? The last thing you want is a stock that is not growing that much and does not pay a good dividend. So dividend stocks and high growth stocks, the stocks that are growing, that are not losing a lot of money, those are going to be the real winners throughout the rest of 2022, in my personal opinion, which would be something like AMC. They're not losing a lot of money, and they do have incredible growth rates as of right now, getting even back to the numbers that they were at pre-COVID. So there you have that. Let's take a look at the Ortex data, and let's take a look at what is going on for the day. We'll go ahead and refresh this page. We could see that the cost to borrow max is now sitting at 17.61%, cost to borrow average at 15%, cost to borrow minimum at 3%. Remember, these are still higher levels that we have been at in a very long time, even still at 17.5%. But Ortex is just wrong in how they are calculating the estimated short interest, and I think that is playing a big role to the cost to borrow rates that we are getting showed, because the estimated short interest of free float is 17.88%. We have not seen the short interest go from a confirmed almost 22% now down to 17.88%, and you have had zero bullish price action, just minus the slight uptrend that we have seen. That's not shorts covering in even the slightest degree. So I do think you have seen a lot of shares that were out on loan that have been getting returned. We've seen about 40 million over the past week, and I think the estimate here is just showing that, hey, some of these shares out on loan are actually being covered, and that's what we are getting seen as the return shares being at even 10.5 million for today. You've seen this number in between 10 million and 20 million for the last couple of days now. So I do think it's just a accounting error. It's, you know, that fine line. And I do think the short interest is likely even still going up, probably still higher than 21.92%. That was the short interest on June 15th. So there you have that. Free flow out on loan still at 27.42%. Shares out on loan 141.35 million. Days to cover at 3.45. Cost to borrow at 16.27%. 100% share utilization. For the option activity, 0% positive order value for the day. Lots of these July 8th orders coming through, and that is this Friday. So you're going to see a lot of market maker hedging when you get these weekly options that start to come through. And we're seeing 5 orders totaling $267.79 thousand. Like I said, positive order value of 0%. So options are really moving the markets as of right now. From what I've noticed, even the S&P 500, it really starts to rally when you start to see a lot of calls coming through, and that's what we seen yesterday. But then you get a flip-flop coming today, and you see a little bit more of that negative pressure. So there you have that. That's pretty much all from the Ortex data. Still have a lot of option activity. So any time from now until July 15th to see a pretty explosive move to the upside, to even see a gamma squeeze, is not off the table in my personal opinion. 502,000 calls that are out of the money for July 15th, 8,600 calls that are currently in the money, and about 100,000 puts that are in the money. All in all, if 50% of the in the money puts went out of the money and 50% of the out of the money calls went into the money, aka just the stock price moves up in a big way, well, that's about 30 million shares that would potentially have to be bought by the market makers if only 50% of the total option activity, you know, started to go in the money, or in the puts case, go out of the money. So I think, to put it in that perspective, you know, to see some pretty explosive moves here over the next week or two is definitely not too crazy and not off the table, in my personal opinion. You do have about 95,000 calls that are currently out of the money for this Friday, and about 4,200 calls that are currently in the money for this Friday. So still respectable numbers, but nothing like that July 15th expiration. And the max pain for this Friday is looking like $13 per share, close to where we are right now, and the max pain for July 15th looks like about $15 per share. So that's all the information you guys need to know. Markets are really freaking out under the scenes, and it is going to make for a big move. Something is about to break. We do have the Fed minutes at 2 p.m. That's going to be the biggest catalyst for this week, but really for today as well. So thank you guys for watching. Hit that like button and subscribe to the channel. Help push this video out to as many people as possible, hopefully to give them some real-time accurate information, not only about AMC but about the markets as well. If you guys want to come trade with me live in real time, link down below in the description, and get your free stocks, also link down below in the description. Thank you for watching, and I will see you in the next one.